All right, welcome back to the Broker's Voice. We go live every Wednesday. The goal here on the Broker's Voice is to shine the light on folks in the benefits and commercial insurance industry that I believe are doing great things that even if they're winning, they're still not getting enough attention, in my opinion. And today's episode is no different. I have got with me Neil Quinn, Chief Revenue Officer of Vittori Health. Neil, how you doing today?
I am doing well. A minor correction. I am Chief Strategy Officer with Vittori Health. One of my
And you know
colleagues
what's
actually
funny?
handles the sales, but I'm probably salesman at heart. So you're not
You
far
know
off.
what? I literally said in my head as we were coming on, he's the chief strategy officer, and then I said chief revenue.
I've been there, my
Can you
friend.
give me a little credit? Strategy at least leads to revenue, right?
It absolutely does. Yeah, that you got a strong umbilical there. Yeah.
Well, I got to ask you just a off the subject question, knowing that you live on the outskirts of Cleveland. You happy Terry Francona won Manager of the Year?
Oh goodness, yeah, of course. This is come on, boom, boom, boom. Up with Cleveland. We've had a few really good shots in the arm over the years, haven't we? So
Yeah, no,
it's
Cleveland, I'm going to still say Indians. I know people hate me for this, but I'm a baseball purist. The Guardians had a pretty cool season. Definitely underrated for how
thank
much
you.
success they had this year.
Yeah, of
So,
course, we're biased, but we would agree with you. And Terry's accolades are great. So not a bad way to come into the winter here.
now if we can just get the Browns to catch up.
Oh, well,
Well, let's talk.
I love your baseball analogies, by the way, and the baseball metaphor. It's so fitting for a lot of the things that you do. I think as we talk here, there's probably some.
Well, you want to hear something really eerie? And I don't know what just made me think of this, but maybe it's the whole Cleveland thing. I remember being in high school. So this would have been early high school, 92, 93. And one of my buddies, baseball teammate of mine, this is when Cleveland was terrible. And the Marlins had just started as an organization. And he made a prediction. I still remember this. And I don't know if it was the right year, but he was maybe a year off. He said Indians Marlins World Series. And they didn't meet at the same time, but then Cleveland went to the World Series. Was it 96, 97?
Mm-hmm.
Against
Mm-hmm.
the Braves, I believe, right?
Crazy was, yeah.
And I just remember going, when that happened, I'm like, whoa.
Yeah.
Because at the time he
Prescient.
made the prediction, Cleveland was probably the worst organization in baseball.
Yeah, yeah.
So
Yeah, there was some clairvoyance there, wasn't there?
yeah, and I remember that's back in the day when the Indians and the Brewers were in the same division. So,
Yeah.
well, let's talk about your journey. You've had quite a journey in the health insurance industry. So, for the folks jumping on who may not know who you are, why don't you just give us a little flashback of where you started in the industry and what's led up to becoming the chief strategy officer at Vittori Health?
Yeah, happy to do a little bit of a travel log, and you can chaperone this and make sure I leave some oxygen for both of us here as we go through. But as I like to say it, I compared to a lot of people, I've got kind of a foot in the grave here. I've been around the block a lot in the healthcare industrial complex, including the employee benefit space, the employer-sponsored health plan space. Cut my teeth way back, way too long ago as a pre-med student and then a master's in kinesiology. And my thought was, I'm going to traffic into the healthcare system as a provider, as a practitioner, and wound up quickly becoming disenchanted during some internships. And even this was literally back in the 80s. And at that point, seeing that healthcare as a healing industry was becoming healthcare as a business industry. It wasn't appealing to me. Fortunately, I made the pivot. I wound up getting into healthcare administration. I was an administrator exec for a long time with the University of Michigan Health System, and watched as it, and probably aided and abetted its sort of sprawling black hole acquisition of hospitals and primary care and specialists. And this is even back then, as it sort of spread across its own geography. And what happened when we bought entities? We controlled the price. When you control the price, what do you usually do with it? Well, you don't usually lower it. You usually raise it, right? Yeah. Wound up having an affinity for innovation, technology, new business ventures, was in technology transfer at the University of Michigan for a while. Created a lot of interesting technology that was cutting edge at the time in helping people make behavior change, things like smoking cessation. Ran the Health Media Research Lab, which was commercialized and after a while bought by Johnson & Johnson. Moved on and was actually part of one of the first DPC groups in the nation. This is back around, Y2K. And we were delivering both occupational health and, we're asked by all the employers, hey, can't you guys just do general health? Can you do non-oc health? And we said, sure. And those were under DPC arrangements even way back then. So it's not, a lot of this is, what's old is new kind of stuff. And then wound up, honestly being on the insurance brokerage side, owning a large agency in the Cleveland area here with a few others for a decade and a half. And so I've seen all the sausage making in terms of how this sort of multi-tentacled, multi-stakeholdered, matrix works. And I call it the matrix. And then wound up selling that, moving into an international professional services firm that was specializing in business optimization and supply chain overhaul. And that was the jump during which Vittori was created, at least the seminal elements. And what would happen is we wound up spending tons of time with private equity firms and their portfolio companies. They would have us land kind of in that sort of overlord position and say, look at everything we're doing, tell us what could be better. And inevitably, the deals guys or the ops guys would say, what is that white hot ember burning a hole in our P&L called healthcare? Why is it inclined that, with this steepness, why is it, such a large number? What can you do about it? And so we set to the task of that. And we quickly realized that trying to do what was being typically done in the industry, which I call manage the racketeering, meaning leaving most things in place and kind of trying to manage around it for cost or better quality or better member service, better experience, was a little like spitting in lava. You're just not going to cool it and you're not going to make any real traction. So it was at that time that the genesis for Vittori Health came about. And we realized that we're going to have to build something brand new from the bottom up. And we had the luxury of standing on the shoulders of others that have come before us, certainly understanding what wasn't working with the BUCA plans, the sort of monopoly plans in the country, and learning from those that had tried, and I give them credit, to look at alternative plans, alternative reimbursement or care delivery plans. And that's how Vittori is born. And so we're moving into our 5th year of paying claims now.
What I'm going to do, Neil, is as we're talking here, I'm going to throw your email up here. So if you're an advisor listening in and you do want to get a hold of Neil and learn more about Vittori, we're going to get into it here in a minute. Here's Neil's email, so feel free to reach out. So I got one question before we dive into more now where you're at today. What led you to make the shift from being on the healthcare side for so many years and then joining the broker side?
So I actually thought I could make a difference. And I think the advisors on the call, and this happened almost incrementally in all of these steps that I've taken in my career. And maybe people are chuckling, thinking, well, okay, you're gonna move from the healthcare side, which I found quickly I wasn't able to make the kind of what I would call magnitude of order change that I wanted. I mean, you're in an entrenched system that's making good money. Let's not kid ourselves on the healthcare side. Everything's happy, don't rock the boat. You would have minor sort of innovations that could happen, but not whole-scale shifts. So I thought, okay, look, maybe I can get on the, look at, half of the country's purchasing of healthcare is done on the commercial side, the employer side. Who directs employers to do that? Insurance advisors, consultants, brokers, right? So can I have an impact there? Joined a group that I thought was pretty progressive. Quickly realized, a decade and a half of quick realization that again, that's herding feral cats is probably what was going on there. Again, follow the money. Always follow the money. And it's you'd think an old guy like me would learn a little quicker, but we all have hindsight is 20/20 sort of thing. But it's these entrenched revenue streams, revenue sources, most of the time people are allergic to change, and they are, status quo is this opium den. So that's how I moved on. And I thought, hey, look, I'm going to get into just business, making businesses better in general. Had no intention when I did that last, sort of jump that I would wind up back in healthcare. And maybe it's a way to frankly atone for former sins. I don't know.
It's kind of a full circle you didn't expect, right?
It's kind of full circle. And now I definitely am, I'm pleased that I didn't just retire. My wife is also pleased, but getting to do some real good now. And it's kind of a true north thing.
Awesome. And we got Chris Fisher joining us on today's episode. And I know you've been on Chris's 3x3x3. If you haven't seen Chris's 3x3x3s, by the way, you got to go check those out. Those are fantastic. Let's talk about Vittori Health now. Being a brand guy, I've asked you this question offline. What does Vittori mean?
We get asked this. It's frankly unusual that we don't get asked it more, but you nailed it. So Vittori is a linguistic derivation of victory. So in Italian and other languages, Romance languages, Vittoria in Italian is victory. And so we just kind of clipped it, made it shorter, easy to say. And our view of that is that employers, it's high time employers became victors, not victims, and certainly their people as well.
I was going to go the other way and say, so what you're telling me is you guys built a romantic health plan.
Hey, you know what? A little rom-com goes a long way, right? Right, Andy?
Let's talk about, so you guys are in the self-funded space. And one thing I want to talk about with you especially is, when you look at the self-funded world in the industry right now, number one, I think there's a lot of advisors out there who are trying to do the right thing, but then they start diving into the world of self-funding and see the complexity that is involved with it. And it does cause some advisors to I know I want to do this, but it's still easy just to sell the all bundled in one package. But we also see advisors who are going down that path and they're just kind of putting things together, nuts, like they're putting Frankenstein together, right? And they're putting all these pieces of a self-funded plan together. They may not all work well together. Let's start here. If I'm an advisor who wants to build a health plan for my clients, help my clients build a health plan for the end consumer, the employee, where should they start?
It's a great question. So, and for all the advisors out there, many of whom have radically changed the way they advise clients, and kudos to them. I meet them every day, as do you, Andy. And these are folks who have dissembled the components, and they have built, sort of curated this artisanal erector set because they understand that the current system is broken. And but then they are, it's when suddenly you're moving from having the painting done, or at least the paint by numbers done for you, you're actually doing the full portrait, and that can be really, really tough. So one of the things that we realized quickly, and maybe the advisors on the call here can relate to this, is that while there's great latitude and license in being able to use existing components and pieces and sort of putting a mosaic together for a health plan that drives lower cost, better quality, value, better member experience, those kinds of things. It's a lot of work. It's a lot of moving parts. There's a lot of coordination, integration. You can have multiple contracts. When things go well, it's great. When they're maybe not going so well, lots of finger pointing. So we actually addressed that in the construction. We actually thought it was a failure point. We didn't want to bag advisors with that. We felt like, hey, can we achieve the same sort of comprehensive integrative offering where it's really just one entity to hug us, or maybe one throat to choke, hopefully not, and make it easy, kind of have an easy button. However, recuse ourselves from what we saw as legacy system components and legacy system economics, sort of whole cloth pieces that just you really want to build a house, from. So that's sort of where we are. That's how we came into this. And then just to your original question, in terms of being maybe having some trepidation around self-insurance, I think we make everything that we do as easy as possible. We actually do a lot of hand holding, and I mean that in a positive way, collaboration, walking arm in arm with the advisors to help them move clients from fully insured to self-insurance. And it's one of those things that's not as scary as it sounds like. If you're going to move to self-insurance, moving with a vehicle like ours that has significant cost suppression for the plan and people makes it a lot easier. So it takes the whole, well, is the juice worth the squeeze off the table.
I was going to ask you that. That's actually a really good point. I'd love you to expound on, which is a lot of employers out there, they just hear the phrase self-funding and they go, because a broker has told them not to. They've heard about too much risk, all this stuff. If you're an advisor who is trying, because we're in renewal season right now, maybe they're trying to get some of their clients to move to a self-funded model. Maybe it's winning a piece of business with a self-funded strategy. How can advisors better, I don't want to say best, better help employers make that paradigm shift that it's okay to move to a self-funded plan?
So, there is it's having the skill set as a coach, as a consultant, and some tough love, being educated, of course. I mean, they're going to have to be educated about self-insurance, which isn't difficult to do, but being skilled in helping to deliver that education to their client to move them along this continuum from the devil, being comfortable with the devil, to down the continuum to alternatives that can really be liberating and create freedom, create control, and allow them as fiduciary health plan sponsors to do the right thing for their plan participants, which is actually the raison d'etre for having a plan. They must do this. So I think it's probably, there's a couple of 2-3 tenets in this. One, they need to, I'm assuming they need to, present the case well, and we'll help them do that. So what does current state look like? What risk is being transferred? What's that cost of insurance? And what's the freight on that? And then what does self-insurance look like? And really, when we're talking about risk, financial risk or exposure, what is that? And how do we quantify that in a way that gets that client or that prospect to say, oh, this is why so many of my peers went to self-insurance a long time ago, are going to self-insurance now, or have told me wherever, at lunch or the golf course or where have you, that they're planning to do it, in the near future.
So let's talk about, if you don't mind going into the details a little bit, because then you get part 2 of this, which is an advisor going, okay, cool. I know I should talk about this more, because I think that's problem number 1. A lot of advisors, if they're not comfortable in their own knowledge, they're not going to talk about it. And what they're missing is an opportunity to bring somebody like you in, who is an expert in this field, and because they feel like maybe they're losing a little of the thunder by bringing someone else in, but at the end of the day, what they're doing is they're enhancing their credibility because they're bringing the right people to the table. Now, the question I get a lot is self-funding, as you and I both know, is just a vehicle. It is not the destination. It allows you to create the strategies you can create to help your clients not only contain cost, but give their members good access to the healthcare system. So the question I get a lot, Neil, is, well, then what should I have in a good self-funded plan? Like, what strategies should I have? Because I want to bring this up before you answer the question. I see a lot of advisors who throw the kitchen sink at a self-funded plan. It works. They save 30, 40%. But at the end of the year, they get fired because they did too much. They threw too much. There was too much confusion. Even though the strategies actually worked, when the members are frustrated on how to use them, at the end of the day, the management team making the decisions are also frustrated, even if you did what you promised you were going to do. So how can an advisor, what components of cost containment should an advisor start with when building an effective self-funded plan?
So, I mean, it's a great question. Let me give you a 1-sentence preamble. No one wants to hear this. And as a person who wants to sell our health plan, you'll be shocked I'm saying this, but I would tell you that 1 or 2 cycles, and unfortunately in the benefits world, this means years, our kingdom, right, to be able to sell 365 and to move somebody on any given day, but plan years are plan years. It really takes education, discussion, and the seeding, seeding this this education about the opportunity. You're not going to do it in some compressed at time of renewal when they get their current renewal and they've got 3 weeks, right? This is not lost on advisors. That's when it can go horribly wrong. And then you conflate that with, as you said, throwing a whole bunch of sort of a box of pieces and parts at this and expect that their executive team and their HR and benefits team are going to swallow this. So I know that sounds strange from somebody who would like to sell something tomorrow rather than 1-2 years from now. But for cost containment, let's get into that. Again, this is going to sound rhetorical, but I can't tell you how often it happens. You cannot get fixated on fixed cost. Don't get fixated on fixed cost. The lion's share of cost in any plan, any plan, especially when you're moving, you're actually laying it out on the workbench for self-insured opportunity, is not fixed cost. By fixed cost, I mean administrative fees, fees to administer the claims, if you will, and stop loss. That's fixed cost. Oh my goodness, maybe 8-12%, of the cost of the plan. The rest, not surprisingly, is claims. It's claims. And so, there's supply side pricing and payment to claims, and there's utilization, how much is being used. It's just, units time volume. So we really want to construct plans that focus. I tell you again, the first and foremost thing is it's the price stupid. You've got to get to a different payment point. You just have to. You'll have people that are willing to sort of do what I call, just a little bit of change, and that's okay. That's okay. I think sometimes when plans achieve only a little bit of savings when they go to self-insurance, it can feed that sort of, hey, we could still go back to being fully insured. We're not getting that much benefit. So it's that balance. You've got to figure out how to drive enough cost savings without, coming in and radically overhauling things. And so we've got a kind of what I call kind of a flagstone, stepwise approach. That's a kind of a durable chassis. So we can have someone come over to us and we'll run a self-insured plan with a national network that's comfortable. Maybe it's familiar. It gives that sort of member comfort, gives the client comfort, and then we can graduate them. And even in the first year, we could also offer a dual option. So our fair market payment plan, which is the answer to what I would call sort of old school RBP plans and BUCA plans, for cost savings, and let people decide at enrollment and then graduate them to plans that save more money for both the plan sponsor and members over time. So I think you kind of got to meet the client where they are. It sounds so trite and cliche.
Well, no, I think your point's well made, because I think a lot of people feel like they're going to come in and right away change a group to the self-funded platform. And sometimes that takes a year or two. And I talk to advisors every week who feel like they've got to move them to self-funding to win the business. And my message is win the business and then become the man or the woman that moves them to self-funding in the next year or two. But let the cost containment strategies drive your 3-year plan. You're not going to put all 5 in this year. Start with 1 or 2, and every year add on a new strategy. That, if you want it to be effective, that is how you got to do it. Quit trying to do so much so quick, and just work on one thing at a time and get damn good at that one strategy.
Yeah, I think the caution there is that, and there are kind of two roads to take here, and so maybe a little self-serving. There's the, hey, I want to work in kind of a traditional environment. This is the advisor thinking to him or herself, and so which could mean that they're going to stay with a BUCA-like network, Blue Cross, United, Cigna, et cetera. And as you said, they're going to sequentially add on some control. They're going to try to do some steerage to lower cost, higher value providers. They're going to try to do something with pharmacy. But it still is a collection of entities, and I will say vendors, that need to be managed to make the whole greater than the sum of the parts. And it can still be used. You and I are fans of using the term Frankenstein and trying to get the monster to behave. It can work. I think ultimately, the other path, and this is what we do, is to jettison most of the whole cloth components because we wanted control at the subcomponent level, whether it's claims paying or prepayment integrity or, pharmacy overhaul. We needed component level, subcomponent level control, sort of like building a custom car. I mean, if I can mod the engine, mod the transmission, do something with brakes and handling, it's a lot different than if I'm just getting, whole cloth pieces, if I'm really going for optimal performance and the experience, the driving experience. So I think there are two paths. Obviously, we'd encourage, our path where it's all integrated. There's literally, it's like you're buying, and I hate to use the analogy, but it's apt. You're working with a fully insured plan that's been completely optimized from the bottom up to drive the kinds of savings that you would see way down the road, maybe with the sort of that collection of parts and pieces, probably not even getting there, or with the, sort of pay and fight sort of, Hellraiser RBP plans.
Well, and we'll wrap up because I'm going to let you do a little pitch here at the end about Vittori and what makes you guys different and why advisors should reach out to you guys. But the example you just gave there, we've been saying Frankenstein, but I'll use a better one. You and I are both cyclists. A lot of people in the cycling world love to go buy the parts and build their own bike. That ain't me. I'm going to go to the bike shop and find the bike that's right for me that's already built. And that's, I think the analogy you're using there is Vittori is that bike already built. Quit trying to put the pieces together because that takes longer. They often don't work in conjunction with each other the way you want to. Why not just go to the bike shop and find the bike that's a fit for you? And that's Vittori Health. So let's wrap up here with, tell us a little bit about Vittori. What makes you guys different in the self-funded world, and how can, other than your email address right here, how can advisors reach out to you guys right now?
Sure, absolutely. And I love the cycling analogy. I think it makes sense. And it's all about, it's about having a bike that you enjoy riding, that's friction-free, pardon the mechanical pun there. But so Vittori is a comprehensive, fully integrated plan. It's next gen. So all the components are built to drive, if any of the advisors had enough whiteboard space and dry markers, I will tell you, this is the plan you would build. We had to reinvent it. So we're having significant cost suppression on the medical side, significant cost suppression on the pharmacy plan management side. And this is all Vittori. So our clients are seeing 30% savings on what they were previously overspending on healthcare. That's the language I use. We have a $1 million guarantee on claim savings. It's not just an admin fees at risk. We will actually, make them whole for a claims savings miss. And we have what members call a Jedi level, remarkable concierge member experience. And I think the most important thing is providers like the way that we reimburse. So without rabbit holing, they're happy to work with us because we're not using a simplistic sort of mono approach to reimbursement like RBP plans. And we actually pay the way they want, which is fast, accurately, and fairly.
Awesome. And I think I'm going to wrap up by saying, we had a LinkedIn. I don't know who joined us here, but they put in the comments, start with the data. I think you and I would both agree. Yes, one of the advantages of self-funding is you got to have access to the data in your plan. Otherwise, it's impossible to build the right strategies if you don't know how your plan's performing.
I couldn't agree more. I'll leave you with a Quinnism. Anybody in a fully insured plan as an employer is riding in the trunk, gagged and bound. Some advancement maybe by moving to just straight up self-insurance gets you in the back seat, and maybe mom and dad are telling you to stop fighting. But if you really want to be at the driver's, holding the wheel, you need to be in a plan like ours.
So we started talking about building a romantic health plan. We talked about health plans that look like bikes, and now we're talking about the fact your health plan's being held for ransom. So that'll be a good way to wrap this up. But Neil, I want to thank you for your time. If you're an advisor listening in and you are looking for a good health self-funded solution for your clients, Neil's email is right below me. Go send him an email, check it out, get a demo, take a look at what they're doing, because they're doing some really good things. So Neil, one more time, thank you.
Thank you, Andy. Appreciate it.
Everybody else joining in, hopefully your Q4 season's going well. Hopefully it's about to wrap up and you can take some time down here for the holidays. So have a great week, everybody.